Gentlemen, do you want to come back to this? He doesn't like all of the work, and this is the president's words, that he's putting into the economy, that believes that the administration credit should be getting, for it only to be taken away from the credit from it or the impact from it because of higher rates. Christopher, do you want to chip in on this one as well?
Trump is by trade is a New York City property developer. He's always going to be against higher rates in his work professional life. Long-term inflation is a real problem. It's a real problem for the economy. It's a problem for the bond market. So I think the Fed will continue on its tact and continue to raise rates.
Yeah, I mean, I think it's simple enough. If you have a fiscal expansion, then a central bank doing its job properly puts interest rates up to balance that when the economy is close to full employment. I mean, it's economics 101.
So why is the president doing this? Because one thing we can assume is that the president isn't stupid. There's always a rationale for this. Is this because he wants to be on the side of voters ahead of the midterms, or is there something else going on?
Well, he's got a scapegoat in the making. Well, what's happened? Why is the economy run out of steam? Well, because they over there put rates up against, his recommendation. I think that's the way he runs a lot of his policies, where if something's wrong, it's not his fault. That's maybe just a personal trait that he has.
Yeah, I mean, I think people were quite impressed with how Jay Powell handled himself in front of 2 days of testimony this week as well. And again, as I pointed out early in the morning, it was ironic that Mr. Powell was so at pains to avoid commenting overtly on trade policy, out of his wheelhouse, out of his beltway, I think he called it as well. And yet the president does completely the opposite by stepping over the beltway line into FOMC policy as well. Let's move on about positioning. Aging bull market is something that I get from your copy as well, but you still think there's juice to be extracted from the equity market, despite the fact that you're reducing a little bit of risk now. Where should our viewers be placing their assets at the moment?
Well, I think it's where you shouldn't be placing your assets as much as anything else.
Okay.
This is maybe a time to defend. Interest rates have started to rise. Corporate bond spreads have started to widen. So I think you need to be looking very hard at your duration and corporate exposure. We were talking off camera about liquidity. Certainly the banking system, because of 2008, 2009, the regs that have come in, they don't have the ability to warehouse client flow. So if you start to see a liquidity event, it will be exaggerated, looking back at how sums of corporate bonds have traded hands in the past. And of course, the corporate bond market is several times larger than it was in 2008, and it has to be refinanced sometime over the next 5 years. So that's going to continue to put pressure on, I keep saying that the world tends to look at what they can see above the water, the 10-year note, your treasury note yield. That's the tip of the iceberg. The damage will be done in investor portfolios below the surface in the spread product area as we go forward over the next 12 to 24 months.
Is there no part of you that looks at front-end yields and thinks actually what's baked into the price now starts to make sense from a buying standpoint, buying opportunity? I was looking very closely at the front end of the US curve yesterday, and it seems as though the market is pricing in a max Fed fund rate around 2020, and beyond that it starts to slope down a little bit. And of course a lot of that is because of the flattening that we're seeing. But putting that all together in an environment where now the T-bill, the 3-month T-bill is offering you better yield than the S&P dividend yield, surely there's some expectation that some of the money that's leaving emerging markets, some of the money that may leave equities could end up in the front end of the US yield curve as well.
That's a good point. I mean, just yesterday I was in the office talking to the team, and I said, well, gosh, wouldn't we want to look to park some money in a money market fund? And they said, what's that? It's the point. Yes, short-term, 12-month T-bills, currently are starting to look very attractive. Maybe in 6 months' time, that's the trade, where you can get close to or above 3% and with 1 year risk.
What do you think the trigger is going to be for the corporate bond market then, given you have an underweight in that market, and presume that you've got it on spread, not just duration?
I think the trigger is it's not going to be where the 10-year treasury trades. It's going to be, effectively, there's going to come a time where the market just says we can't digest the amount of treasury issuance that's coming to the market, and there'll be corporate issues that are not subscribe for. You know, it'll be a slow burn, but it'll be there'll be losses in the most conservative clients' portfolios that typically have bonds.
I mean, I guess the way I look at this is if you're a Japanese investor, you buy 10-year US treasuries while you've got any slope to the curve because you get nothing at home. But if you buy 10-year US treasuries and you hedge it out, you get whatever is in the slope of the curve. And that's why the curve gets flatter and flatter until finally it gets close to zero, at which point it's no longer worth Japanese investors putting any money in, and they stop buying, and at that point, 10-year yields shoot upwards.
I'm afraid has to be the final word on this. Christopher, nice to see you, sir. Have a great weekend. Christopher Peel, Chief Investment Officer at Tavistock Investments.